Today's lecture is on internal control concepts in accounting information systems. At the end of this lecture, you should be able to examine ethical and fraud issues within the AIS environment, identify the factors that contribute to management and employee fraud, explain the objectives of internal controls and its importance to an organization. You should also be able to apply key elements of internal control structure within the COSO framework and explain categories of control activities, namely IT controls and physical controls. Now, the basic concepts of internal controls here will help you understand the important control procedures within the transaction cycles and transaction application systems, which you will cover in the latter topics. So first and foremost, why are we studying internal controls? Why are they so important? But before we actually go on to these concepts, let's look at some well-known companies. Companies like Enron, WorldCom, Informatics, and the National Kidney Foundation, or NKF. What do you think they have in common? Let's see. Enron actually made use of special purpose entities to hide liabilities through off-balance sheet accounting. WorldCom transferred transmission line costs, which are their expenses, to asset accounts, allowing them to defer operating expenses and report higher earnings. Informatics, which is closer to home, recognized premature revenues by including their course fees as revenues for classes that were not yet conducted. And the National Kidney Foundation had some problems with patient subsidies, pay increases that were backdated, and money that was spent lavishly on first-class tickets as well as golden taps. Now, the common problem in all of these companies was the occurrence of fraud. Now, if internal controls were implemented and maintained properly, of course with management support, these problems could have been detected earlier and managed before it became a big issue. So many of these scandals in the stock market and computer crimes and charges of fraud by corporate executives arise from the violation of ethics standards in business practices. So we like to actually provide you with some definitions of some terms that you're going to be seeing a lot of in the following slides. The first one would be business ethics. Now, business ethics in this instance refers to a set of moral rules that govern how businesses operate and how business decisions are made, especially in an ethical dilemma. And fraud refers to an intentional deception, misappropriation of company assets, or for that matter, the manipulation of the company's financial data to basically gain advantage. And it can actually be done directly or indirectly because of a lack of internal controls. Now that we've defined fraud, let's actually look at some factors that contribute to management and employee fraud. So there are three main factors that contribute to fraud. We call this the fraud triangle. The first one is your situational pressures, where an employee could actually be experiencing financial difficulties. Second would be available opportunities, where there are poor internal controls and therefore more options to actually perform such a deed. And thirdly, ethics, where the personal characteristics and morals of an individual employee would actually come into play. Now, it should be noted that an individual with a high level of personal ethics, when confronted by low pressure and limited opportunity to commit fraud, is more likely to behave honestly than one with weaker ethics who is under high pressure and exposed to greater fraud opportunities. So in a normal situation, if management can't control the person's traits nor his environment, what else can management control? So in this instance, it's not about just not making it easy to commit fraud. It's about placing an effective internal control structure in the organization. In our study of internal controls, we need to know that fraud can be committed not only by operations staff, but by management as well. Now, the Enron, WorldCom, Informatics, and NKF fraud cases were committed by management. Therefore, you need to know the differences between employee fraud and management fraud. Let's take a look at employee fraud first. These frauds here are committed by non-management personnel, so your lower level staff, and it usually consists of perhaps an employee just taking some cash or assets for personal gain by actually, bypassing something in the system, and that is the internal controls. Now, management fraud, on the other hand, basically is done at a higher level by management or managers. It frequently involves perhaps changing something in the financial statements to create this illusion that the company is actually healthier than it actually is. And if it is actually with reference to a misappropriation of assets, then it's usually with very complex business transactions. Did you get the preceding question correct? What are the three factors that make up the fraud triangle? They should be situational pressures, available opportunities, and the ethics or the morals of an individual. Now let's move on to the objectives of internal controls and its importance to an organization. So how does an organization block the opportunities for fraud to occur? Well, it's by implementing and maintaining an effective internal control structure. And there are four broad objectives in internal control. And they are: one, to safeguard the assets of the firm; to ensure the accuracy and reliability of accounting records and information; to promote efficiency in the firm's operations; and to measure compliance with management's prescribed policies and procedures. So what then are internal controls? Now, internal control system comprises policies, practices, and procedures, that's your 3 Ps, employed by the organization to achieve these objectives. And inherent in these control objectives are 4 assumptions that guide designers and auditors of internal controls. It is actually management's responsibility to establish and maintain a system of internal controls. The system must provide reasonable assurance that the objectives of internal controls are met in a cost-effective manner. If it's too expensive, it's not worth it. Now, the control techniques used to achieve the objectives may vary with different types of technology or even methods of data processing, as well as the internal control system does have limitations on its effectiveness due to the possibility of honest errors, circumvention through collusion. I could actually be, working with somebody else, management override of controls, changing conditions rendering your existing controls being ineffective. Figure 3-2 shows the internal control system acting as a shield to protect the organization's assets and information from various undesirable events such as unauthorized access, fraud by people in or outside the organization, errors due to faulty computer programs or incompetent staff, or mischief acts caused by computer hackers or viruses. Now, the absence or weakness in internal controls is called an exposure and is illustrated by holes in the shield. Any exposure or weakness in internal controls will increase the risk of having assets being destroyed, or for that matter, information being stolen, or the risk of information or the information system itself being corrupted or disrupted. Now, exposures therefore increase the organization's risk to financial loss. The internal control shield comprises 3 levels of controls: preventive, detective, and corrective. We're going to look at these 3 levels in a little bit more detail. We start with preventive controls. Preventive controls are your first line of defense. They force compliance to prescribed procedures. Preventing errors and fraud is far more cost-effective than detecting and correcting the problems after they occur. Majority of such undesirable events can be blocked at this first level. An example of a preventive control is the use of a well-designed source document. Now, when a source document is well designed, all required data is captured and therefore minimizing any input errors. Now, if an undesirable event gets past a preventive control, the detective control is designed to expose it as a second line of defense. They reveal errors by comparing actual occurrences to pre-established standards. Now, an example is the use of a batch control total. If the batch control total generated by the GL system is different from the manual total, it will reveal that the journal entries are not entered correctly. Finally, corrective controls will actually fix the problem. So the three levels of controls are preventive, detective, and corrective, or PDC for short. Hopefully you got that question correct. Now let's move on to the key elements of the internal control structure in the COSO framework. Now let's look at the internal control shield that organizations adopt to protect themselves from the undesirable events. It is called the COSO Internal Control Framework. Now, COSO stands for the Committee of Sponsoring Organizations of the Treadway Commission, and the framework is put forward by the committee for companies to adopt and implement an adequate system of internal controls over their financial reporting processes. There are 5 key elements in the COSO internal control framework, and they are: number 1, the control environment; 2, risk assessment; 3, information and communication; 4, monitoring; and 5, control activities. We will cover each element in detail for the rest of this lecture. The control environment is the foundation for the other 4 control elements. The control environment sets the overall tone for the organization and influences the control awareness of its management and employees. Important elements of the control environment are as follows. In general, if top management values integrity and good business ethics, the control attitude and mindset will filter down to the lower management and operations staff. Similarly, an organization with its structure put in place, its board of directors and audit committee roles clearly defined, responsibility and authority properly delegated, sound HR practices in recruitment of competent staff of good ethics, etc., is likely to have a good control environment within the organization. Regulatory requirements of compulsory audit and good corporate governance practices also contribute to a good control environment. Risk assessment is the process of identifying, analyzing, and managing risks relevant to financial reporting. And risk can arise from circumstances such as the following: changes in external environment that impose new competitive pressures on the firm, new personnel who have inadequate understanding of internal controls, rapid growth that strain existing internal controls, or the introduction of new product lines or activities which the organization has very little experience in, or the restructuring, downsizing, or implementing new technology which could affect transaction processing, or a change in accounting policies that impacts financial reporting. Now, it is important for management to assess the extent of these risks and then decide how to minimize them by making adjustments to the internal control structure and procedures. The accounting information system plays an important role in ensuring good quality information is generated and communicated to management for their decision making. An effective AIS will identify and record all valid transactions, provide timely information in appropriate detail to permit proper classification and financial reporting, accurately measure the financial value of transactions, and accurately record transactions in the time period in which they occurred. Monitoring is the process of assessing that internal controls are functioning as intended, either through separate procedures or through ongoing monitoring. Adopting separate procedures for monitoring is to gather evidence of control adequacy by testing controls and communicating control strengths and weaknesses to management. This could be done by having internal auditors make checks and recommendations for improvements to controls. Ongoing monitoring may include having either computer systems integrated into routine operations or having management reports highlight trends and exceptions from normal performance. Finally, the final element are the control activities. Control activities are policies and procedures used to ensure that appropriate actions are taken to deal with the organization's risk. Control activities can be grouped into 2 distinct categories, namely IT controls and physical controls. IT controls are controls which relate to the computer environment, while physical controls are controls which relate primarily to human activities employed in accounting information systems. We will examine them in greater detail as part of our last learning objective. Let's now delve a little deeper into control activities. We start with physical controls. As mentioned earlier, physical controls are controls relating to human activities employed in the organization within the accounting information system. Note that physical control activities are relevant in both manual and computer-based accounting information systems. There are 6 categories of physical controls, and they are transaction authorization, segregation of duties, supervision, accounting records, access controls, and independent verification. The objective of transaction authorization is to ensure that the transactions processed are valid and in accordance with management's objectives. There are 2 types of transaction authorization: general and specific. General authorization is normally used for routine transactions. They are granted to operations personnel to perform day-to-day operations, like in a computer-based AIS, where general authorization could be embedded in the computer programs. For example, any inventory level below the reorder point could trigger a purchase transaction to take place. Specific authorization is usually used for non-routine transactions in a case-by-case basis. An example is authorizing the extension of a customer's credit limit beyond the normal amount. In a computer-based AIS, the above transaction may trigger a message to the credit manager for special authorization. Segregation of duties aims to minimize incompatible functions so as to reduce opportunities for any person to be in a position to perpetrate and conceal errors or irregularities in the normal course of his duties. This is done by having the following 3 control objectives as general guidelines. Control Objective 1 states that the person who authorizes transactions must not be processing the transactions. For example, the purchasing department should not initiate purchases until the inventory control department gives authorization. The separation of tasks is a control to prevent employees from purchasing unnecessary inventory. The employees will need to collude before they can commit the fraud. Control Objective 2 states that the person who is in custody of the asset should not be in charge of recording the transaction. For example, the department that has the physical custody of the inventory, the warehouse, should not keep the inventory records. Accounting for inventory is performed by the inventory control function. Now, if this is not separated, assets can be stolen or lost, and the accounting records falsified to conceal the event. The third control objective is to separate incompatible accounting tasks such that no individual has sufficient access to accounting records to perpetrate a fraud. For example, journals, subsidiary ledgers, and the general ledger are maintained by separate staff. It is important to note that duties that must be separated in a manual system may be combined in a computerized system. For example, updates to the subsidiary ledger and general ledger are done together. Also, in a computer-based environment, it becomes important that programmers should not handle transaction processing. What happens when segregation of duties may not be possible or practical, especially in a small organization? Now let's assume there are 5 incompatible tasks, but there are only 3 staff to handle them. In this case, supervision should be adopted. Supervision is often called a compensating control. That is, it is a control that compensates the absence of segregation controls with close supervision. However, this is with the assumption that the organization employs a competent and trustworthy employee for supervisory control and efficiency. Do note that more supervision is typically necessary in a computer-based system as segregation of duties is reduced. If you recall, accounting records capture the economic essence of transactions, and that includes source documents, journals, and ledgers. Proper and adequate accounting documents and records would serve as evidence of transactions and ensure proper recording of transactions and events. They also provide an audit trail for both internal use in the conduct of day-to-day operations as well as in financial audits. Now, in a computer-based AIS, accounting records are mainly stored in computer files, such as transaction files, master files, archive files, and reference files. The purpose of access controls is to ensure that only authorized personnel have access to the firm's assets and information. Unauthorized access exposes assets to misappropriation, damage, and theft. Direct access controls include physical security devices such as locks, safes, and alarm systems, and the use of passwords in a computerized environment. Indirect access controls are done by controlling the use of documents and records and segregating the duties of those who must access and process these records. Now, access controls are important in computer-based AIS to prevent unauthorized individuals from viewing, retrieving, corrupting, or destroying the organization's databases. Independent verification refers to checks of the accounting system by an independent party to identify errors and misrepresentations. Now, do take note that verification is not supervision. Supervision takes place while the activity is being performed by a supervisor with direct responsibility for the task. Verification takes place after the completion of the task by a person who is not directly involved with the task. Now, through independent verification, management can assess the performance of individuals, the integrity of the transaction processing system, and the correctness of data in accounting records. Comparing physical assets with accounting records and reconciling the subsidiary ledger with control accounts are just two examples of independent verification. So, did you get it right? What are the 6 physical control activities that we have actually identified so far? They are transaction authorization, segregation of duties, supervision, accounting records, access controls, and independent verification. Now we're going to be looking at some IT application controls. The primary objective of IT application controls is to ensure the accuracy of a specific application's input, files or databases, programs, and output. This objective applies to all types of application systems, be it your sales order system, your purchases system, your GL system, your AR, and your AP systems. Now, there are 3 broad categories of application controls. They are input controls, processing controls, and output controls. If you recall the general model for AIS in Lecture 1, which includes the following components: data collection, data processing, database management, and information generation, the question is, how do the 3 categories of IT application controls fit into this picture? Let's see. The 3 categories of application controls are to ensure a transaction is accurately entered into the application system, it is properly processed, and outputs are accurate and properly communicated to users. Input controls are applied during the data collection stage. They are programmed procedures or edits which perform tests on the transaction data entered to ensure that they are free from errors at the data collection stage. There are several types of edit checks made to the data entered to ensure that errors are minimized. For example, in entering a sales invoice transaction in the AR system, the system will prompt the user of errors in the following instances. For a missing data check where the invoice amount field is not entered. For alphanumeric check where the customer number field is entered with the customer name. For the limit check where the invoice amount exceeds the credit limit allowed for the customer. For the range check where the customer number of a local customer entered exceeds the range assigned for local customers. And for validity checks where the customer number entered is not found in the customer databases. After passing through the data input stage, transactions enter the processing stage of the system. Processing controls are programmed procedures in the system to ensure that an application's logic is functioning properly. Processing controls consist of batch controls, run-to-run controls, audit trail controls, and master file backup controls. Let's take a look at these examples in a little bit more detail. Batch controls help reconcile system outputs with the input originally entered into the system. The batch control record is created when the batch of transactions is entered into the system. The data in the batch record are used to assess the integrity of the batch during all subsequent processing. Run-to-run controls use the values in the batch control record to monitor the batch as it moves from one program procedure, one run, to another. Audit trail controls ensure that every transaction can be traced through each stage of processing from its source to its presentation in the financial statements. The system does so through the use of transaction logs. Master file backup controls ensure that the databases are properly backed up at all levels of processing in case of any processing problems. And finally, output controls are a combination of programmed routines and other procedures to ensure that output from the system is not lost, misdirected, or corrupted. Where information generated is confidential, its privacy should not be violated. Examples of output controls include controlling the hard copy output and controlling digital output. Now, controlling hard copy output can be in the form of having output spooling to prevent bottleneck in printing, the spoiled or unused computer outputs being properly disposed of, reports are properly distributed to users who are allowed to receive or view them through the use of a secure mailbox, or having special courier services deliver the reports to these users, and end user controls where the user should report any errors to appropriate IT management, and these reports need to be stored in a secure place after use. Now, to control digital output, it could be directly sent to the user's screen or printer. Well, congratulations, you've completed Lecture 2. In this lecture, you've defined business ethics and fraud. You've also looked at the fraud triangle and differentiated between employee and management fraud. You've also defined the internal control system and its objectives, looked at exposure and risks, and identified the key elements of the COSO framework, of which physical control activities and IT application controls are a part of. Well, I look forward to seeing you again in Lecture 3. Take care now.